Hello and welcome to this Frontier View webinar. Today we're going to be discussing the outlook for Sub-Saharan Africa in the second half of 2020 and going into 2021 with a thematic focus on the post-coronavirus recovery and what multinationals will need to expect from the region in the next several months. So I am William Atwell. I'm head of the Sub-Saharan Africa research practice here at Frontier View, and I'm joined by my colleague Matt Kindinger, the Associate Practice Lead for Sub-Saharan Africa.
Hello, William. Hello, listeners. I'm looking forward to running through the SSA view with you today.
Great. So moving swiftly ahead, we're first going to take a look at the key drivers and the outlook for Sub-Saharan Africa as a region, informing listeners around our assumptions for the forecasts and what it means for businesses in Sub-Saharan Africa. Then we'll take a look at some of the really key markets, do some deep dives and unpack some of the further details around our forecasts and assumptions for market analysis in what we call the tier one markets, Kenya, Nigeria, and South Africa. And we'll also be supplying some takeaways and recommendations to help inform business planning for the region. So in terms of our expectations and assumptions for COVID-19 and how it's going to affect forecasts and assumptions going forward, there are a number of key assumptions here. The one is that coronavirus is not going away either this year, in the second half of the year, or going into 2021. We still don't expect a vaccination to be widely available until late next year, and various kinds of restrictions will remain in place for some time. Lockdown rules, disruptions to trade, and of course weaker demand and weaker confidence likely to persist for many months still. Now, looking at how this affects the global economy, we've made a number of important downgrades to our forecast for big global markets. And this, of course, is going to affect SSA markets, principally in the form of weaker export demand, but also weaker investment in the region from big companies based in the US, China, Western Europe, for instance. One of the other important implications that this global slowdown has had, and is particularly important for some of the commodity exporting markets in SSA like Nigeria or Angola or Zambia as well, is the effect of this significant slowdown in demand on commodity prices. In particular, oil, we're expecting around $30 a barrel, $30 per barrel average oil price in 2020, rising somewhat in 2021. Matt, perhaps since you cover Angola and Nigeria in some more detail, you can provide a little bit of color around what the implications are, perhaps around government finances and currencies as well.
Certainly. So the two markets in Sub-Saharan Africa that will be most directly affected by the decline in commodity prices, in particular oil, are Angola and Nigeria. Angola will be affected most directly, and this is because it has an extremely high dependence on oil for both export revenues, forex earnings, as well as government revenues. So very significant decreases in exports and the position of the government's fiscal outlooks. In Nigeria, it's also very dependent on oil for exports and government finances. So we are expecting currency depreciation, currency volatility in both markets, as well as much weaker public spending, especially when it comes to investment into infrastructure projects. So certainly a much weaker outlook for both markets.
Thanks, Matt. And of course, the markets that are exporting mineral resources like Zambia, of course, affected by the very low copper price coming in from weaker demand from China, but other big global markets as well. And similarly, affecting exports, export earnings, and government finances quite significantly. And this is really represented in the significant deterioration of public finances we're seeing across SSA. Many markets now categorized as being at high risk of debt distress, either because they've taken on very significant debts over the past several years, and now with the deterioration in the external environment, those debts are becoming much more expensive to service, but also where we have very high levels of external debt, like with Zambia, for instance, very difficult to service given the weaker export earnings and significant depreciation of the currency, making that external debt much more expensive too. So a number of markets are important to watch from a public finance perspective. Also has implications for how these markets then recover going into 2021. With relatively limited fiscal resources, not so easy for many of the governments in these countries to provide the kinds of fiscal stimulus that we're seeing in other parts of the world. So quite difficult and creating difficult challenges that are going to persist into 2021, and in some cases actually beyond that as well. So when it comes to coronavirus in SSA itself, we've talked about the global context and how it's impacting SSA economies. Coronavirus was later, occurred later, and infections began to pick up later than in other regions, but it's since accelerated quite considerably. Over doubling of cases in many of the key markets. It's very difficult, of course, to get a very clear view of how coronavirus is spreading, given limited testing capacity in some of the region's markets. Others are somewhat opaque as well. So Tanzania, for instance, being very opaque about the data that it publishes. So we don't really have a clear view on how coronavirus itself is spread. But what we do know is that it is spreading. Cases are likely to continue to rise in through Q3, potentially stabilizing somewhat in Q4, and that this is putting real strain on the public health systems, far less capacity than developed markets to be able to cope with a pandemic. So understandably, the response from governments has been to lock down their economies. In some cases, this was very strict in Uganda, Kenya, South Africa, for instance, some of the strictest lockdown rules in the world. This has had a really detrimental impact from a socioeconomic perspective. And as a result, governments have started to ease some of the lockdown rules, despite the fact that cases are continuing to rise. So this is a pattern that we're seeing in aggregate, a general easing of lockdown restrictions, but it's by no means an even process. So in some markets, they're easing, and others, they are actually creating stricter conditions. In South Africa, for instance, lockdown measures were eased, and then some were reimposed, banning alcohol, for instance, or extending curfew rules. Matt, I know in places like Nigeria, it's been a bit of a patchwork as well, complicated by differing rules across subnational entities across Nigeria's state. Perhaps you could provide a bit of context around that as well.
Certainly. So Nigeria is a very good example of a multiple, or a country which has multiple levels of administration. You have the federal government and then the state governments. And the federal government has introduced quite a clear set of rules for particular parts of the country, but state governments have been much more, a lot less predictable in the way that they've implemented lockdown rules and also removed lockdown rules. So it does create quite a lot of confusion for businesses in terms of where lockdown rules are heading. There are also two other countries that are probably worth mentioning in terms of their contrasting views or contrasting approaches to lockdown rules. One is Ghana. It introduced a brief lockdown. It was one of the first countries globally to remove its lockdown just a couple of weeks after it was introduced. And in contrast, you have a country like Angola that continues to implement quite strict restrictions or limitations on domestic and international travel. So another illustration of quite differing approaches to containing the pandemic.
Sure, and as one can imagine, this creates a big headache in terms of business planning for the region overall. Quite difficult to understand where your distributors are able to operate easily, where they are subject to very strict rules, and where there might be border restrictions. I know within the East African community, the fact that we have different levels of rules across the trading bloc means that actually one encounters quite significant bottlenecks when trying to get goods across borders, through ports, that kind of thing, subject to lots of tests and also bureaucratic hurdles. So certainly a lot of complexity when we're looking at this patchwork across the region. So in terms of what the authorities are doing in response, we know that there's been a very severe downturn in April, May, especially many economies, private sector activity still contracting, even in July as measures have eased. Zambia stands out there, but also South Africa. Of course, this has now had a very significant effect on our forecast overall. I mentioned earlier, a relatively limited scope for things like fiscal stimulus, which we'll talk about in some more detail in a moment. But we've downgraded our forecast for a number of the key SSA markets, many of them in quite deep recession: Zambia, South Africa, Nigeria, Angola standing out. A number of these markets facing, of course, pre-existing challenges. In Ethiopia, we've downgraded our forecast quite considerably to a sort of multi-decade low, but this comes on top of other difficulties that the market was facing, from political volatility, which is impacting investment levels as well. Cameroon also facing quite significant levels of political volatility and unrest. And South Africa, of course, was already in contractionary territory before coronavirus hit. So we've downgraded a number here. I think it's important to be cautious about the growth numbers for 2021. One, because of course we're operating in an environment of heightened uncertainty, so forecasting always dangerous in this context. But also, given that we're coming off of a very low base in many of these markets, a few percentage points of growth in Nigeria or Angola, and Matt, I'm sure you agree, doesn't represent a bounce back to 2019 levels of economic activity or levels of demand.
No, certainly, and we'll see when we look at Nigeria in a little bit more detail. We would expect many countries that are experiencing recession in Sub-Saharan Africa this year not to return to their pre-pandemic levels until the end of 2021 or 2022. So yes, a recovery, but not a return to normal pre-pandemic levels of activity.
And this is maps across different industries as well. We know that there are certain industries that are unlikely to return to 2019 levels either in 2021 and possibly not even in 2022 either. Tourism, of course, being the kind of extreme example, with global aviation really severely affected by coronavirus and the effect it's had on sentiment and confidence. And of course, the very real risks that travelers face. Other areas, a bit more normalization towards the beginning of next year, and certainly mid next year. Some areas like manufacturing, sort of consumer demand, beginning to normalize perhaps by the middle of next year. But certainly areas of weakness persisting, areas that are dependent on public finance in particular, likely to experience weakness, especially in those commodity-dependent markets, which are some of the most exposed to the downturn. So cuts to government capex, for instance, likely to affect the construction sector in many areas, both on sort of big public infrastructure projects, but also in some cases commercial and residential projects too. So a period of prolonged weakness there. IT and telecoms has really been a beneficiary of this environment, and we'll talk about that in a little bit more detail in a sort of market by market context. But certainly when it comes to sort of e-commerce in very specific urban settings, there has been a bit of uptick there, and certainly opportunity for technology providers. So in terms of what donors, governments have been doing in response to the downturn, I mentioned earlier, very little scope for stimulus, and that's certainly been reflected in the GDP forecasts and also in the sort of higher frequency data that we were exploring earlier on. There are a number of initiatives that have been floated at a global level, loan forgiveness or sort of delayed debt payment programs, also additional loans and support provided by the multilateral institutions. Recently, one of the largest loans given to South Africa from the IMF, also received money from the BRICS Bank, the New Development Bank, Kenya, Nigeria, Ghana, all accessing emergency credit as well, which is in general going into programs very directly related to the COVID-19 response program. So not necessarily a wider fiscal stimulus and bailout package, but helping at least to ease some of the pressure on those public health systems and on public budgets as a result of the downturn. But we wouldn't say that this is necessarily solving the fiscal crises that many SSA markets are facing. It's going to continue for several years still. To provide a bit of detail on specific areas of support, South Africa is, as I mentioned earlier, the largest package of supports, and one of the only ones that can really be described as a kind of extensive stimulus program, equivalent to around 10% of GDP. Is a whole range of areas, tax incentives, income support programs, things like that. Kenya, rather more limited in its scope and its scale, a lot focused on sort of tax deferment and things like that, which of course is exacerbating the fiscal problems that Kenya is facing, and additional spending really mostly focused on the health system. Matt, from any of your Central and West African markets that you cover, any particular highlights when it comes to the support measures?
Yeah, so I mean, Nigeria's is definitely the largest in terms of the support measures in West Africa. However, we don't expect it to have a significant effect in practice in stimulating economic activity, because it's really quite narrowly focused on a couple of industries. So obviously the healthcare sector is receiving extra support through this package, but the government is prioritizing support for local agriculture and local manufacturing. So if businesses are operating in sectors that are not directly exposed to those sectors, they probably won't see much benefit. Ghana is also providing a bit of a support package. It's also offering things, sort of incentives such as deferment of tax deadlines, but overall the scope of the support mechanism or the support package is fairly limited, and part of the reason is because the government has been a lot quicker in opening up the economy, so it has less to do, you could say, in terms of having to support the economy through this period.
And the bounce back is happening somewhat sooner in Ghana relative to some of these other markets. The other response that we're expecting to gather more pace in 2021 and going forwards is how these economies stimulate economic activity, or at least provide support to their local industries. We know that employment vulnerability has been a big theme in the SSA experience of COVID-19. Of course, with so much business informal and employment informal, very difficult and in some cases very impossible to have things like furlough programs where the status of their employment is very informal. So that's certainly had a direct hit to incomes, and governments are very keen to begin to stimulate industries that would at least provide a bit of formal employment or sort of better quality jobs going forward. And manufacturing in many cases is seen as an opportunity to do that, as is things like value added agricultural activities and so on. So a big theme we'd expect going forward is more emphasis on localization. Governments also, of course, aware of their vulnerability to global supply chains and some of the disruptions that have happened during the course of the past sort of 6 to 7 months. So a bit more self-reliance and more focused on local manufacturing, local value addition. In many ways accelerating trends that were already happening. So we know that Nigeria had been imposing certain restrictions, FX availability for certain kinds of imports. Similarly, Cameroon had been looking at more sort of protection from imports, and South Africa, Kenya, Ethiopia had been offering various kinds of incentives for manufacturing for some time. But we expect this to gather a bit more urgency going forward as they try to rebuild the economies and in particular focus on job creation. So looking at some of the financial implications of the downturn that we've seen so far, we know that emerging market currencies took a big hit, particularly March, April, to some extent May, a bit of stabilization, but of course still significant weakness in the last several months, and we'd expect to persist really through the rest of the year. The rand being one of the most affected, of course, being very highly traded emerging market currency, and along with the Turkish lira, or the Mexican, Russian currencies as well, really taken quite a significant beating. Matt, perhaps you could talk us through some of the devaluations we've seen in some of the oil producing countries.
Yeah, so the two countries again that are most notable are Angola and Nigeria. We've seen Angola's devaluation, or the sort of reform of the currency, started to take place before the COVID-19 pandemic and the decline in oil prices. The country's devaluation of the kwanza was very much overdue, but the pace and the scale of the depreciation of the kwanza really is accelerating as a result of the decline in oil revenues. And so we are expecting quite significant depreciation of the kwanza over the coming year. In Nigeria's case, the government and the central bank have also been forced into a position where they have to allow a little bit more flexibility into the exchange rate regime, although they're not allowing the naira to depreciate as much as they probably should allow it to. But again, we have seen some pretty sort of sudden and dramatic changes to the exchange rate regime in that country as well, and this volatility is expected to continue over the coming year or so.
Yeah, of course, we see a range of different monetary systems in SSA, and that has a range of different responses. But there are a number of similar themes running through all of this. Pressure from FX demand, very weak exports, pressure on FX reserves, very pertinent factors across a number of these different markets. When it comes to monetary policy itself, we've had interest rate cuts, which of course hasn't supported currencies, but at the same time, in several markets, Kenya is a good example as well, we've had some interventions by the central bank into currency markets to provide a little bit of more stability, or at least prevent the currency from weakening even further. So the shilling, for instance, is a good example of that, although it has weakened quite significantly compared to 2019, and we expect a little bit more depreciation next year too. In some cases, this is translating into a bit of additional imported inflation, although there isn't really any one specific trend that can be said to apply to the whole region. In South Africa, for instance, the very significant lockdown that we had, particularly in April, May, June, hit demand so significantly that inflation fell to very low levels, despite the fact that there's rand volatility. In other markets, food prices have been a real driver of inflation. In Ethiopia, parts of West Africa too, we've had double-digit inflation, so really pressuring consumers and businesses' ability to spend. But there are two sub-regions that are perhaps a bit more stable here. The one is Francophone West Africa, certainly the currency stability there helping the inflation situation, and one of the, and that's a really key factor, I'm sure you'd agree, Matt, underpinning the macroeconomic stability or relative macroeconomic stability of that region in Francophone West Africa. Parts of East Africa too, Kenya, Uganda, inflation relatively stable, helped by some of those central bank interventions in the currency, but also a gradual improvement in terms of the food price stability outlook there. And of course, across the region as a whole, fuel prices have been pretty low by historical standards, and that's brought down transport inflation. So rather a mixed bag when it comes to the inflation outlook. But those markets where there is very significant, in some cases, double-digit or near double-digit inflation, certainly pressuring incomes and exacerbating that downward demand trend that we've been seeing across the region as a whole. Looking forward, we do expect inflation to pick up somewhat going into 2021 and 2022 as oil prices rise, fuel prices rise. The other key thing to watch here is what happens with taxes. We mentioned earlier that one of the only levers really that governments have had in order to provide a bit of support and relief for businesses and households has been in deferred taxes, tax holidays, things like that. But really going forwards, given the very dire fiscal situation that so many governments find themselves in SSA, we don't expect that kind of regime to be able to last. So as we go into early next year, we would expect most of these markets to move towards a bit more tax normalization, and in some cases actually tax increases later next year. We already know in South Africa they've flagged a number of tax increases, around 40 billion rand of additional tax revenue planned for 2021. We don't expect big increases in income taxes or corporate taxes necessarily, but there are a number of measures, higher duties on certain kinds of products, for instance, where we would expect the South African authorities to try and claw back some additional funds. So cost environment generally likely to increase in 2021 going forwards. Now, just to round out, I suppose, the regional element of our presentation today, and I'll shortly be moving on to hand over to my colleague Matt to provide a bit more detail on the Nigeria story. This downturn takes place in the context of a range of pre-existing tensions and issues, as I mentioned earlier, Ethiopia being one example, Cameroon another. Just recently, we've had a coup in Mali as well. So there are a number of political tensions that were boiling away anyway, and now have been exacerbated by the fact that people's incomes are under pressure. Governments in some cases have responded to COVID-19 in quite authoritarian ways, which has exacerbated some of the anti-government feelings or pre-existing grievances. So we just represent here a couple of the key risks to watch. Certainly for the markets I cover in East and Southern Africa, Islamist terrorism has been a risk for some time, but if anything, given the downturn and the socioeconomic fallout, certainly prime context for that kind of activity to continue and to spread. And we know that activities have really picked up in parts of coastal northern Mozambique, and have certainly been a risk along the Kenyan, Tanzanian, and around the Horn of Africa coast for some time. Ethiopia, as we move towards the election next year, amid higher joblessness, higher cost of living, relatively poor state of the economy, we'd expect some of those separatist groups to really gather some momentum and use the election as a sort of reason to mobilize further and demand more autonomy. And we expect further regions to demand more autonomy from Addis Ababa going forwards. And Matt, when it comes to the West Africa story, perhaps you could provide a bit of context around some of the risks we're seeing in Cameroon and the Sahel.
Certainly, yes. So the West Africa region is an area that is particularly affected by insecurity and political risk at the moment, and will be going forwards. And there are a couple of things worth mentioning, as like you've touched on, Will. One is Cameroon. So Cameroon effectively has been in a state of low-level civil conflict. Some are calling it a civil war in the Anglophone regions for a number of years now. These tensions are likely to be exacerbated by the COVID-19 pandemic and will result in probably an increasing cycle of anti-government action, followed by clampdowns by government forces, especially in Anglophone regions. So this is a risk certainly to watch. In Nigeria, it's affected by Islamist activity in the northeast of the country, as well as farmer-herdsman conflicts in the center of the country. So a number of issues there to monitor, although I would mention that they won't be directly affecting urban customers and urban operations of companies, but nonetheless a risk. In terms of the political landscape, so two big elections in West Africa over the coming months. One is Cote d'Ivoire, so there's a presidential election taking place in around about 2 months' time in October this year. It's quite a fraught political environment and an increasingly fractured political landscape. Most recently, we've seen the very untimely passing of the nominated successor to President Ouattara. President Ouattara has then subsequently decided to run for re-election, which is very controversial, given that he's been the president for 2 terms now. So we are expecting increased political risk and tensions around the election, with a protracted period of political violence or a risk of political violence over the coming months or so. We don't expect a return to civil war, but certainly high risk of commercial disruption as a result. Ghana's election, however, is expected to pass off relatively peacefully, given the country's very strong record of peaceful exchanges of power. So quite a mixed bag for the region.
Great, thanks very much, Matt. Now, given the risk, the currency issues, the very varied and uneven policy responses, and the different pace of lockdowns being eased, and of course all of these elections and potential turnover of political leaders and changes in the regulatory environment coming out of that, certainly a very complex region to try and plan for. And given how so many of our clients have indirect business in the region and operate across a portfolio of markets through distributors, this is making, of course, planning around channel and the sort of appropriate route to market, how to tap into the opportunities that there are while managing the risks that are certainly very heightened, extremely complex. Perhaps you could talk us through some of the key route to market implications before we round out the SSA part of the discussion in some of those deep dives.
Certainly. So there are two major areas that have really, or two major factors that are really becoming apparent for multinationals' route to market in Sub-Saharan Africa as a result of the current pandemic and economic slowdown. One is around demand. So we have seen a combination of much weaker demand growth in some industries and some countries, demand contractions quite quickly, quite sharply over a very short period of time. And the other is changing customer spending behavior or customer demand. So local partners, channel partners are having to adapt to both weaker demand, but also more demanding customers or customers that are trading down and becoming more frugal. This does really test the channel capabilities in terms of being able to sell new products or to sell to customers in different ways over this period. So a major pressure there. The other major issue or area that is affecting route to market represents or corresponds to operational challenges, the business landscape overall. So we've seen a couple of things emerge recently, and these will remain challenges for the rest of the year and into 2021. And these correspond to supply chain disruptions, route to market, or operational disruptions caused by border closures, COVID-19 restrictions, local partners facing delays getting their products into market, as well as selling to their final customers. So this does increase costs, result in potentially lost sales for customers. So a significant disruption there. The other major issue is issues around forex shortages and FX volatility. So this does subject or increase the risk of channel partners facing sudden FX related losses, as well as difficulties planning around movements of currencies over the coming months. So definitely issues around planning as well. What this means for channel is that channel partners, multinationals' route to market structures need to work harder, and they need to change the way they work quite rapidly over the coming months. So certainly a lot of pressure for channel partners, a lot of pressure for multinationals to perform in this context.
Thanks very much, Matt. And I suppose turning to one market that has never been simple to operate in and now is potentially even more challenging is Nigeria. So if you'll bear with me for a moment, I'm just going to swap over the presentation to Matt. He's going to walk you through the Nigeria portion of this webinar.
Thank you, Will. So just before I jump in, can I confirm that you can see my screen that I'm sharing?
I can, yeah.
Brilliant, fantastic. So to get started, as Will has said, Nigeria has never really been a straightforward market to operate in, but it is nonetheless very attractive. So it garners a lot of attention from our clients. To start off with, it's quite helpful to get a sense of how things have changed in terms of the major drivers for the Nigerian economy. A bit like South Africa's economy, Nigeria has not entered the pandemic from a position of strength. The economy was performing moderately well before the pandemic. There were many downside risks before, and we are seeing these downside risks exacerbated, especially from an external global perspective with regard to weaker commodity prices. But there's also been a number of issues that have emerged domestically that will really pressure the economy and make the operating environment a lot more challenging over the coming year or so, especially with regard to getting products into market, as well as public finances that will put the government. In terms of how governments, how businesses have felt the effects of the COVID-19 pandemic and the slowdown, we've seen quite a significant deterioration in business confidence. The chart on the left corresponds to what expectations are for various sectors over time. We saw a very sharp deterioration in business confidence in March all the way through to June, with a moderation in July, but nonetheless still fairly weak data coming out. So this does mean demand overall is expected to be fairly weak for the rest of the year. But in terms of operating conditions, also very difficult for most companies. We saw quite a significant reduction in order book volume, as well as capacity utilization, and also notably issues around accessing credit, which has always been difficult in Nigeria, but the COVID-19 pandemic has really exacerbated this. As you can see, we are seeing a bit of a stabilization in conditions in July, but nonetheless not nearly as positive as they were before the pandemic. Another indicator that sort of illustrates the effect of the slowdown and the crisis on businesses is the Purchasing Managers Index. A figure above 50 represents an improvement in conditions. We have seen the PMI number peep over 50 for the first time in July. This is a positive development, and it shows that things are normalizing and largely reflects the removal of lockdowns in the major, or sort of the slow removal of lockdowns in the major demand centers of Abuja and Lagos. But nonetheless, we are not expecting the PMI figure to return to levels that we saw in 2019 and early 2020, mainly because operating conditions will remain quite difficult in Nigeria. As we mentioned a bit earlier, one thing that is going to present a challenge over the course of, or the remainder of 2020, but also into 2021, is the uneven nature of lockdowns in Nigeria. And although the direction of travel is towards looser restrictions in terms of COVID-19 commercial restrictions, there is likely, well, we are expecting from time to time that certain state governments will introduce new restrictions on short notice. And so this could cause disruption for local partners and route to market issues in the future. As we know, Nigeria's economy is very exposed to oil, global oil markets, although the economy overall has a fairly, or oil makes a fairly low contribution to GDP. I think it's around about 10 to 15%. It is very important for exports and government revenue. So this oil price crash that we've seen in 2020 has been much more severe than the one that we saw in 2016 globally. And given that Nigeria's economy fell into recession in 2016, we are expecting this oil price to have quite an outsized effect on Nigeria's economy. One thing that's worth noting is that we are not expecting there to be any real positive benefits from the low oil prices, and this is because Nigeria already has a very heavily subsidized transport fuels. So although in countries like South Africa and Kenya we are seeing lower fuel prices, which could help businesses recover from the slowdown, this is not the case in Nigeria. This really illustrates Nigeria's dependence, and actually increasing dependence, on oil as a source of export revenues and forex revenues. What we've seen over the last couple of years is increasing dependence on oil, which makes it especially vulnerable to the current oil price decline globally. And this is also overlaid with a decline in domestic oil production that we've seen, partly because of lack of investment in oil wells, but also because of OPEC mandated production cuts, which are restricting domestic oil production. So we are expecting a very sharp decrease in, or sharp contraction in oil exports this year, followed by a moderation next year, which will not really make up for the loss of 2020. Oil obviously affects government finances quite directly in Nigeria, and this is because although the government has tried to broaden its tax base away from oil, it hasn't made very much progress. The oil sector still represents around about 40 to 50% by our estimates in terms of the government's source of revenue. So the figures you can see here on the screen correspond to the government's pre-pandemic budget. So before the pandemic, it was still very dependent on oil as a source of revenue. But it also was facing a very high debt servicing bill. So this makes it incredibly vulnerable to the decline in oil prices globally. So what does this all mean for the growth outlook for Nigeria? So we are expecting Nigeria's economy to contract by about 3.6% this year. This is the deepest recession the economy will experience, or would have experienced, I think, since 1983, so quite a significant downturn. The contraction in economic growth is likely to reach its lowest point around about Q3, although the economy will continue to contract well into 2021. We are expecting a tentative recovery at the beginning of Q2 or Q3 2021, and this is going to be the result of a stabilization in oil prices and a bit of a recovery in export earnings and government revenues. Nonetheless, we're not expecting a broad-based recovery to occur until the end of 2021 and into 2022. And the recovery in 2021 is unlikely to make up for the losses sustained in 2020. So this is quite a useful chart in illustrating how long it will take for Nigeria's economy to return to pre-pandemic levels. So for multinationals looking at understanding their addressable market and when demand will return back to their pre-pandemic levels, we are estimating that it will take until around about mid to late 2022 for the economy to return to its pre-pandemic size. So for companies looking to sell to the public sector, Nigeria's government budget is one of the largest in Sub-Saharan Africa, I think second only to South Africa's. So it does represent substantial opportunity, but the oil price crash will have significant negative implications for government investment and spending over the coming year. We are expecting government revenues to fall by around about 40% this year as a result of the loss of oil revenues. It could be more than this. The government has responded, the federal government has responded by introducing a new budget that sees capital expenditure reduced by around about 11% in real terms. In our view here at Duck Frontier, we are expecting this to actually be, the contraction in capital expenditure to be a lot larger. So we don't expect the government to implement its 2.47 trillion capex budget as expected. And there's also likely to be quite significant contractions in recurrent expenditure in 2020, so around about 9 or 10% this year, followed by a sustained contraction in real terms in 2021. And this is because the oil price crash this year will have lingering effects on public debt, and the government will be forced to allocate an increasing proportion of its total finances to servicing debts, which will squeeze out finances available for recurrent expenditure. So much weaker demand over the coming year or so. Consumers certainly have been affected by the pandemic, and we have seen, though we saw a pretty sort of healthy improvement in consumer spending in 2018 and 2019, this was largely a result of pre-election spending and a stabilization of the economy over those years. But if you look to the left, you can see consumer sentiment has tapered off quite rapidly over the last couple of quarters. And even before the COVID-19 pandemic, most consumers were stated that they were intending to spend less over the next 12 months than they were over the previous 12 months. And the COVID-19 pandemic has really exacerbated this trend. So we are, through the end of 2020, expecting consumers to trade down or cut back on non-essential items or seek better value. So the pressure to discount is likely to be quite present. We are expecting a bit of a recovery in 2021, with a more sustained consumer spending recovery in 2022 as inflation falls and government spending starts to pick up a bit. One of the major operational issues that multinationals face in Nigeria is issues around access to foreign currency as well as the exchange rate. There have been quite significant reforms introduced in Nigeria for corresponding to the exchange rate in recent months. So starting on April 30th, the central bank introduced a degree of more flexibility into the exchange rate, and most recently in July, the government the central bank allowed the naira to depreciate even further. So what we have seen is officially a harmonization of the unification of multiple exchange rates, but in practice, what we have seen is a depreciation of the naira. What multinationals can expect over the coming months and well into 2021 is, although the central bank has stated that it is intending to allow the market to increasingly set or determine the value of the naira, in practice, the depreciation of the naira is still a very politically sensitive issue, and we expect the central bank to allow the naira to depreciate very suddenly with little notice, followed by a repegging to the dollar at a certain level. So a series of stepped depreciation over the coming months and into 2021. This means that local partners are likely to face issues around planning, especially with regard to setting the exchange rate at which they access dollars, but also issues around dollar access are unlikely to be resolved by this new exchange rate regime. So although we could see a period of weeks after depreciations where access to dollars improves, because oil revenues remain very weak, and that's the major source of foreign currency in Nigeria, access to foreign currency will remain a significant challenge for the foreseeable future. And we don't see this, we don't see the status quo really changing until at least the next election, which is in 2022. Another major operational issue for companies in Nigeria corresponds to inflation. So we have seen the inflation rate creep up slightly over the last couple of months, especially driven by imported prices. So as the naira has depreciated, the price of imported products has risen. But we've also seen the food price inflation rate rise as a result of restricted food supplies and issues around border closures that have meant that imports of food have fallen. We are expecting the inflation rate to average around about 12% this year and fall slightly through the early 2020s as the currency stabilizes somewhat and the economy picks up. But we do expect inflation to remain in double digits, and this does mean that local partners will be under pressure to discount as customers remain price sensitive and their purchasing power is eroded. But at the same time, they'll be looking to minimize their costs and protect their margins. So quite a difficult period over the next 3 to 6 months for local partners. Another major operating issue for companies in Nigeria at the moment, and one that has been exacerbated by the coronavirus pandemic, corresponds to issues around getting products into market. So the government has introduced a number of restrictive border closures and import bans that have made it very difficult to get products into market unless the companies are importing via Lagos port. So border closures have been introduced to contain the COVID-19 pandemic and also restrict the import of agricultural products, but this has forced a lot of products through the port of Lagos. And given the restrictions to international air travel, we aren't expecting to see the supply of goods to become easier into Nigeria for the foreseeable future. So companies are facing increased costs and congestion getting their products into markets before they sell it to their final customers. Definitely an issue worth monitoring. We are expecting these restrictions to be eased somewhat over the course of 2021 as the coronavirus pandemic eventually recedes, but this will remain an operational challenge for local partners for the foreseeable future. Another issue that is worth monitoring is the security landscape in Nigeria. We touched on this a bit earlier, but the security challenges, especially in the east and the center and the east and northeast of the country, are chronic issues that are unlikely to disappear over the coming year or so. One thing worth mentioning is that most companies and most customers will not be affected by insecurity, especially those in Abuja and Ibadan and Lagos and Kano. But it is worth noting if companies are looking to sell to rural customers or customers in the Northeast or transporting products by land through these areas, it will remain a bit of a challenge for. So given the current stresses and difficulties around planning that local partners are facing and companies face in Nigeria, it's worth considering incorporating some form of scenario planning into your plans for Nigeria for the coming year. As you can see, we've gone through our base case. Under a scenario where oil prices deteriorate quite significantly and the COVID-19 pandemic resurges in a major way, we could see a much deeper recession. So that is worth planning for. Given this is especially true given Nigeria's dependence on oil, we've already gone through. So Nigeria is particularly vulnerable to a further decline in commodity prices, although that is not our base case. It's also worth noting that even under an upside scenario where oil prices improve to levels that were, higher levels than we're currently forecasting, the economy will still be in a recession this year. So it is still worth planning ahead for this. Nonetheless, working with local partners to devise scenarios is quite a prudent way of trying to anticipate disruptions to your plans for the country. Great. Well, I'm going to hand over back to my colleague Will, who will now go through the South Africa outlook for you.
Thanks very much, Matt. With the South Africa presentation, we're going to keep it fairly concise. This is because we actually have a fairly detailed South Africa webinar, which is available on the Frontier View portal as well as on the Frontier View YouTube channel. So for a full 40-minute webinar focused entirely on South Africa, we would advise you to take a look at that. But today we're still going to provide an update on some of the key highlights and also the forecast revisions for South Africa briefly, and then I'll also do the same for Kenya too, before wrapping up with a couple of key takeaways and recommendations for the region as a whole. So when it comes to South Africa, actually to a greater extent than Nigeria even, entered the COVID crisis from a very weak position. The economy was already contracting before coronavirus hit, and a number of industries had been contracting by quite a significant degree for some time. Mining, for instance, had experienced a really difficult period. Manufacturing has had its challenges too. And in Q1, this was all exacerbated by a period of electricity blackouts called load shedding, which really sent the economy into a tumble. So since then, we of course had very severe lockdowns in South Africa, as we discussed earlier on with the color-coded maps. And we've seen the effect of this in some of the high-frequency data which has been released recently. So in the last few months, we have most of the data for Q2, and beginning in Q3 now, we can see that retail sales really fell off a cliff as a very large number of retail outlets were forced to close. People's movement was restricted, and of course confidence has fallen to really historic levels. So retail sales, of course, one element of an important one driving overall activity in the economy. Industry as well really fell very significantly in Q2 too, and we expect that to be represented in the GDP data when it's released in September. We're expecting a unprecedented fall in GDP in Q2 this year. You can see it, and it has affected virtually every industry as well, particularly heavy industry. but really no industry's been unaffected by the slowdown, and that's represented in some of the more recent manufacturing capacity utilization data. And you can see the effect of the electricity production and the slump there, and the effect it had on industry and what we might term the real economy. Public finances have also been affected by the economic slowdown. Very significant reductions or revisions in terms of the government's expectations for its own revenues from personal income taxes, from corporate taxes, from VAT, all much, much lower. And this is from the government supplementary budget that it released in June. As we discover the full extent of the slowdown in Q2, these might be revised down even further. As a result of very weak revenues, but at the same time higher spending requirements in order to provide some of those stimulus and additional healthcare spending measures that we talked about earlier in this webinar, the government has had to borrow much more, and we expect to continue to borrow more as we go into 2021 and into the medium term. So this is really one of the big risks in the medium to longer term is South Africa's debt position. Of course, it had already been downgraded to junk status, and debt servicing costs have been rising. External debt, not quite as much of a risk as in some of the other SSA markets like Zambia or Ghana even. A lot of the debt is domestic, but nevertheless, debt sustainability going forward is going to be a big question, and debt servicing costs in particular going to be eating into funds that would otherwise be available for government procurement and spending. So certainly that's an area that's going to come under pressure and is going to be less of a contributing factor to GDP growth going forward. So what have the authorities been doing, or what have they been able to do? The immediate response has been from the central bank, the South African Reserve Bank, a series of interest rate cuts. Was actually began the easing cycle in July last year, but certainly in the first 6 months of 2020, we've seen a success of further cuts. So we come down to 3.5%, which is a record low for recent years. We haven't seen necessarily a big boost in terms of credit growth, which is perhaps expected given the weak confidence at the moment, and also rather more cautious lending practices by banks. We know that although the government has provided guarantees for a range of soft loan options to help businesses survive the crisis, actually the rollout of those soft loans and guarantee schemes has actually been fairly weak. So it hasn't really driven the credit growth that it was intended to. So certainly not looking good from a demand perspective driven by any credit on the back of these easier credit conditions. The other plank of the response from the authorities has been the fiscal stimulus program. We mentioned 10% of GDP being the headline number there, and provide a little bit of context here around some of the kinds of responses. Without this, we would expect the downturn to be even deeper. But with it, we do expect still a very deep recession. The depth, the trough of the curve really in Q2, but the economy actually still contracting in annualized terms in Q3. Actually, recently we've seen the return of electricity blackouts, which are really hammering industry, manufacturing in particular, but really all businesses, and of course providing a lot of inconvenience for households too, and additional costs and so on. So real disruptions to the economy caused by the resurgence of electricity blackouts, and of course the additional electricity demand created by the mid-year winter conditions in the southern hemisphere, exacerbating that. The economy returning to some semblance of stability in Q4, helped of course by a bit more momentum in the global economy too. And then technically returning to growth in 2021, 2022, as the global economy gathers further momentum, and we see most of the lockdown restrictions that have persisted through 2020 being eased. But as with Nigeria, it's actually quite helpful to index this in local currency terms to GDP as we saw it in 2019. And we can see even with 2 years of presumably and sort of technically positive GDP growth, we still don't actually get back to the 2019 levels of economic activity and demand, even by sort of the mid-2020s. So this is a real hammer blow to the South African economy, which is going to last, and certainly businesses will need to adjust their assumptions for the kind of returns and the kind of demand and sales that the South African economy can deliver, both in 2021 and 2022, and potentially look at some of the other more resilient markets in SSA for compensating potentially for some of those weaker sales. So we'll talk about the Kenya case in a moment. Some of the other key forecasts for South Africa to take on board include the outlook for the rand we mentioned earlier, certainly really hit hard by the fall in sentiment that we saw towards emerging markets in Q2. The inflationary impact of that actually relatively muted in 2020, just primarily because of the fall off in terms of demand that we saw, which has really pushed inflation down. Lower fuel prices contributing to that somewhat too. The rand has begun to regain a bit of ground relative to the dollar, but remains very weak, and certainly any movements in terms of sentiment from global markets, as we learn more about the Q3 recovery in the Northern Hemisphere, certainly would, in the context where markets are very skittish, affect the rand very significantly. So expect lots of short-term volatility in the rand, both in the rest of Q3 and Q4. The general trend being in 2021 towards regaining a little bit of ground, but of course being much more significant, much weaker than we've seen in previous years relative to the dollar. South Africa being very globally exposed, one of SSA's most open and globally integrated economies, of course very exposed to any changes that we see in the global environment and any changes in our underlying base case assumptions for the global economy. So should we see a return to very strict lockdowns in big global markets like Europe and North America later in 2020, and we see a deeper global recession than we're currently forecasting, that would have a big impact on South Africa, as would some of the local drivers as well. So if we saw, for instance, much higher trend towards populist policy measures that would deflate any potential for investor interest, we could see a much worse downturn, a recession potentially in the double digits for 2020. Even under a base case, as with Nigeria, we expect even under an upside scenario, we'd still expect a recession. So important to take that on board as well. Even if things start to trend better than expected, we'd still expect recessionary conditions for South Africa, driven in large part by that very significant downturn we saw in Q2. Just a few further risk areas to take on board and build into assumptions for South Africa. There are a number of regulatory measures that the government is looking at. Several of these have been on the books for several years now, but if anything would be given an extra boost of momentum due to the COVID-19 downturn and the need to appease certain political constituencies. So further momentum behind the National Health Insurance program. We don't expect it to be rolled out in anything like the form it is outlined in by the government's policy papers, but elements of the NHI continuing to be rolled out going into 2021 and 2022. A Black economic empowerment, of course, a very important pillar of the ruling ANC party's economic policy agenda. In many instances, quite worrying to international investors, and certainly in many cases adding additional costs for foreign companies operating in the country. And a new area which I think is quite concerning for financial investors in particular, and certainly adding to a bit more pressure on the rand potentially going forward, is an ANC proposal around using pension pots as a source of funds to fund infrastructure projects to restart the economy in 2021. So that's certainly been an area of concern, and is going to be very concerning to local middle and upper income consumer segments as well. Right, so to wrap up our deep dive portion of our webinar today, I'm going to provide a brief overview of the Kenya outlook as well. Now, Kenya, a very different story to either Nigeria or South Africa, that had been benefiting from fairly healthy fundamentals for several years now. 2018 was a big boom year. 2019, not booming nearly so much, but still very healthy GDP growth overall and fairly healthy growth across most industry sectors too. When it comes to how COVID-19 has hit the economy, of course, there was a slowdown, weaker export demand, particularly by mid-year, lockdown conditions in many parts of the country affecting economic activity, consumer sentiment, business sentiment. So we did see a slowdown, but it's coming from this relatively strong position. Now, in terms of our forecasts for the market, we do expect growth to slow down very significantly to around the 1% mark. So not a recession expected, but as you can see from these key demand drivers for GDP, consumer spending significantly lower, contraction in overall investment, and of course government spending somewhat higher, helped by some of those donor schemes and additional measures to support the economy. So, we do expect job losses, of course, in both the formal sector and the informal sector. There's been challenges in the agriculture sector as well. Coming out of the end of last year and early this year, drought conditions and also a very large locust infestation, which has affected many parts of East Africa, affecting in particular rural households and rural households' spending power and their incomes really hurt by that locust infestation, which affected harvest. So a number of factors hitting the Kenyan economy, but given the very high growth rates we're coming off of, not too much of a hit in terms of the risk of a recession. We don't expect that in our base case, at least. Looking at the economic prospects across different industries, understandably, as we expect at a global level and a regional level, there are industries that are likely to experience big structural challenges that will take quite a long time to recover from. So tourism, very important source of jobs for the Kenyan economy, likely to struggle well into next year and potentially towards the end of next year as well. Kenya generally a long-haul destination for Asian, North American, European tourists and visitors, so we expect the hospitality industry and the jobs associated with that to take some time to recover. Agriculture, as I mentioned, had a very difficult start to the year, but we expect some normalization towards the end of this year and a return to relatively normal conditions through next year. When it comes to manufacturing, we mentioned earlier that localization is going to be a big focus for the Kenyan authorities in 2021 and going ahead to 2022, when the government faces an election and President Uhuru Kenyatta's administration, the Jubilee Party, is likely to want to show some progress towards its pledges, towards job creation and increasing the proportion of manufacturing as a percentage of GDP. So we expect incentives and further supports for the manufacturing sector to come online and help that industry recover relatively swiftly from sort of early next year onwards. And of course, all the additional healthcare spending that's been going into the public health system, but also coming from donors too, has meant there's been a lot of procurement demand in that space. When it comes to the financial oriented forecast, I mentioned that the shilling has weakened, understandably, as have other emerging market currencies. The central bank of Kenya has intervened from time to time to stabilize the shilling, so it could have trended much weaker otherwise. We expect a bit of further weakness in 2021 and 2022, but generally not the kind of scale of volatility that we're seeing in some of the commodity dependent markets, where we're seeing forced devaluations of quite significant scale. The impact of this means that imported inflation is a factor, but it's not driving inflation significantly higher. We do expect inflation to tick moderately higher next year, but not to the extent that it really undermines spending power by consumers or businesses to any significant degree. Looking at the regulatory agenda, we've talked about the manufacturing program and how it's really a big focus of the government's recovery efforts. It forms part of a wider package of reforms that has been a hallmark of the current administration, which they call the Big Four program, manufacturing being really key, but also food security, enhancing productivity in agriculture, and trying to reduce some of the big swings in food production and food prices that we've seen in previous years. And it's been a real source of anxiety and concern from a socioeconomic perspective. The other potentially offering some further opportunities for multinationals going forward is the Universal Health Coverage Program. That's likely to gain further momentum as we move towards the election in 2022. A number of pilot programs have been launched under the UHC, and certainly additional budgetary allocations have been made towards health projects too. The idea is to gradually extend the coverage of health insurance in Kenya, and over time we'd expect the addressable market for both pharmaceutical product companies and companies selling medical devices and equipment to grow, and certainly offering some further opportunity. Some additional money going into the affordable housing program, providing opportunities for construction companies, but that's going to take a bit more time, and certainly the fiscal resources available for that are going to be a bit more squeezed, given the Kenya's debt buildup and the debt servicing costs associated with that. So that's perhaps not rattling ahead as rapidly, but certainly some further opportunities to be had for multinationals in Kenya's construction sector going forward. As with the other markets, we would highly recommend that multinational executives plan using scenarios. Kenya's economy a little bit less vulnerable to a sort of deep slump or recession compared to Nigeria or South Africa. The fundamentals are a bit more supportive, but certainly if we had a worse than expected global downturn, or further shocks to the agriculture sector, which is such a key employer and source of exports for Kenya, that could present further risks, and a risk of potentially a shallow recession in 2020 going into 2021. However, that's not our base case, but we would advise that companies plan for it and use these signposts to assess whether it's likely to trigger a downside scenario. Now, we understand we've covered a lot of ground, both at a regional level and at a market level, and SSA is always a difficult region to cover because it's so diverse and so vast. But there are a number of general trends from a business standpoint that we would recommend companies take on board. We've talked about some of the route to market implications of some of this volatility, but stepping back and looking at the region as a whole, I think there are a couple of key themes. 5 really stand out for us. The one is that the recovery will be a multi-speed one. We've talked in some detail about how Kenya is going to recover somewhat more rapidly than the other 2 big markets, which will have prolonged weakness and also even longer weakness when it comes to certain kinds of industries, but across the portfolio of 49 SSA markets, quite a patchwork in terms of the recovery. FX payments and FX availability continuing to be a challenge, particularly in those markets like Angola, Nigeria, Ethiopia, Zimbabwe, very acute challenges there as well. So it's certainly necessary to plan for payment delays or even non-payment, and a range of credit risks when it comes to local partners and local customers. Some of those route to market challenges important to plan for too, expecting delays at ports and border crossings, certainly a perennial challenge in SSA, but exacerbated by the regulatory unevenness across the region. I think one area that is important and difficult to perhaps get visibility on, given some of the data opacity that is sort of part and parcel of doing business in SSA, is how demand profiles will shift. And Matt, you mentioned something earlier around how companies are thinking about different package sizes, perhaps as demand profiles shift, and we see middle income consumers shifting into lower income or lower middle income groups. Perhaps the kinds of products they buy, or the unit sizes, or the regularity of their purchases might change. But perhaps you could just share a sort of anecdote on that front.
Yeah, certainly. So I've spoken to a few of our clients recently who have noticed very tangibly changes in customer demand and customer preferences for more affordable products. And so what they've done is that they've been able to introduce smaller package sizes. They've also been able to introduce more lower priced but still good value products for customers. And they're actually expanding the sales forecasts for lower priced products compared to more premium products over the foreseeable future. And this is because of much weaker customer demand for more premium products. So having this agility to adapt package sizes, reposition products, introduce more affordable, lower priced products does bode well for companies looking to maintain market share and sustain sales growth despite weak macroeconomic performance.
Yeah, and that can involve trading down, and certainly we'd expect consumer income profiles to shift generally downwards. We do expect poverty levels to increase in many of these markets, and certainly some of that progress towards the growth of the middle class will be hit. But also the distribution across public and private as a source of opportunity for areas like healthcare, for instance, could change too, particularly as we see, say, the public sector playing a larger role in the provision of healthcare in places like Kenya and South Africa, as well as potentially places like Ghana as well. When it comes to the political risks, very important to stay close to channel partners, certainly increase monitoring and sharing of information that can help anticipate some of the risks and some of the disruptions that could come with higher protests or regulatory challenges too. And certainly very important to maintain visibility on these developments as they unfold. A couple of final takeaways when it comes to multinationals and planning across markets, customers, channel, payments, and pricing. We won't go through all of these today, but this deck will be available on the Frontier View portal, and so will this recording, and on the Frontier View YouTube channel. But across all areas of business, really, this is quite an unprecedented period for SSA. We do expect the region to continue to offer opportunities in 2021 and going ahead, but of course business success is going to depend on very careful planning and potentially a much more granular view of these markets when it comes to conducting planning and assessing demand and opportunities. Any final takeaways from your side, Matt?
Well, I think the implications that really stand out for me when I'm speaking to customers is trying to adapt to shifting centers of demand growth. So certainly ensuring that multinationals can double down on their core markets like South Africa, Nigeria, Kenya, but also thinking about how they can work with their distributors, their channel partners to capture growth in markets that are not experiencing a recession like Ghana, Cote d'Ivoire, and a couple of others. So that's really, really top of mind and something to think about over the coming months.
Great. Well, thanks very much for joining me, and thanks everyone for listening. As we mentioned, this recording and this deck will be available on the Frontier View portal, and we look forward to welcoming you to future webinars from Frontier View. So thanks very much for your time. Cheers.
Thanks very much. Bye-bye.